This is the Financially Simple Podcast, the show dedicated to destroying the complexities of money for today's small business owner. The content in the show is for informational purposes only. This show is not investment advice. Instead, seek help from a competent financial advisor or conduct your own due diligence. Justin Goodbread, CFP, is an investment advisor representative of Heritage Investors, a registered investment advisor only conducting business in states where it is properly registered or is excluded or exempted from registration requirements. Registration is not an endorsement of the firm by securities regulators and does not mean the advisor has achieved a specific level of skill or ability. Here's your host, pizza-loving, certified financial planner, Justin Goodbread.
And welcome back to the Financially Simple Podcast. Today we're going to continue our deep dive into cash flow as part of our discussion for personal finances for business owner. I'm dealing with a particular subject today, which is one that I'm often asked a lot of questions about. Maybe you've asked this. And the question is, should I, the business owner, put my spouse on the payroll? Should I put my spouse on the payroll? I'm going to go ahead and put a major disclaimer at the beginning of this episode, as I'm known to do, because you're going to have to talk to your planner specifically about your particular situation. I'll give you a case in point. If you're an S corporation, some of the things I'm going to talk about today and reasons why you may consider putting your spouse on the payroll may not be eligible to you because of the 2% rule that governs the S corporation. So every little thing that I'm going to talk about today has some caveats to it. But if you follow it and you speak with your planner, your CPA perhaps, your CFP, whoever your business advisor is, and I'm going to tell you probably your business advisor and your tax advisor, then you may get some really good information that can help you build your net worth. So as part of cash flow, one of the questions we often ask is, should I put my spouse on the payroll? And many times people are trying to figure out how to get more income into the family. And that's why the question comes about. I'm going to approach it from a different standpoint. I'm going to give you 9 reasons why you may consider placing your spouse on the payroll. As we talked about in the previous episodes, if you've already done your budget and you've done your T-chart, as I've talked about in the past, then you know how much money you need coming into your family. That's not the issue. It's not, should I put my spouse on the payroll to create more income to my family? Now the question becomes, should I put my spouse on the payroll for some sort of a benefit? So I'm going to give you 9 reasons. And these are generic in nature, but I think you can use the concepts to speak with your advisors. If you don't have an advisor that thinks like this, man, reach out to me. Maybe our team could help you. We have a number of good CPAs that we work with nationally that know small business and work in this area. We have a number of tax attorneys that know small business and work in this area. And some of these ideas came from them as I was preparing for this, but I want to give you some insight. So the absolute number one reason I can think of to place your spouse on your business as an employee in your business or into your business as a potential partner or shareholder is to, number one, maximize your 401k or maximize your retirement planning. So in 2019, we're able to place $19,000 as an employee into our 401k plan. Now, if you're over the age of 50, you can put $25,000 in your 401k plan. Some of the ideas I'm going to talk about here are going to have some payroll taxes involved, but they're minor in nature. So I've done this in a scenario that we're going to talk about Fred and Tina today through several of these scenarios. So Fred and Tina are our target couple. And in this particular case, we're going to make Tina the owner of the business. So let's say that Tina makes $100,000 a year in income, and Tina is deferring, let's say, $25,000. She's over the age of 50, so she can put in $25,000 into her 401k. And the company in this illustration is going to match $25,000. So Tina's putting in $25,000 and the company is matching $25,000. Now that could be through a profit share. It could be through a safe harbor. It could be through a pure match. I'm not getting into those details today, but nonetheless, she's putting in 25. The company's putting in 25. So we have a total now going into the company of $50,000. But what if we add Fred to the payroll? And instead of paying Tina $100,000, let's just pay Tina $70,000. And then we're going to take the $30,000 that we were paying Tina and we're going to give it to Fred. So Tina makes 70, Fred makes 30. So we're still getting the same exact income from the business as before, But now we are splitting that income between husband and wife in this case. It can be significant others. Nonetheless, you're going to put your spouse in this case on the business. And in this case, Tina's making 70 and Fred's making 30. Now, if Tina makes 70, she can still put her $25,000 into the company. In 2019, Tina can put in $25,000. She made 70, so she can put in 25. Guess what? So can Fred. So now Tina puts in 25 and Fred, because he now pays 30, he can put in 25. And to keep it super simple, let's say the company's match of 25, we're just going to split it between Fred and Tina. And so Tina gets 17,500 and Fred gets 7,500. The difference being is that before, by not adding Fred to the business, Tina was only able to defer $50,000. Now they're able to defer $75,000 just by splitting the salaries and adding your spouse to the business. It's an excellent way to maximize. Now we're going to come back to this, but there is a reason why I'm only paying Fred $30,000. We're going to talk about this in a few points about Social Security, but I want you to just tuck that away in your head as a little nugget we're going to speak about here in a few minutes. So that is, to me, the primary reason, the number one reason to place your spouse as a member or as an employee, potentially as a unit, as a member, as a shareholder, whomever on your business. The number one reason I can think of is for retirement maximization. In this case, I use a 401k example. The same thing works with a simple. I mean, you can run a number of different scenarios here using whatever plan that your particular company has. But I like the 401k for small business owners. It's an excellent plan for maximizing your net worth. So that's the number one reason. So here's some reasons why you may place your spouse on the business as an employee that you may not have thought about. So the first one is health insurance benefits. It may be cheaper to cover your spouse as an employee rather than a dependent on your health plan. You see, many times we'll add the primary business owner as the covered employee, and then we'll put the non-covered employee, the spouse who doesn't work, as a dependent. But it may be cheaper to add your spouse to the business because they can get cheaper health insurance. Just a thought. And while we're talking about health insurance, by adding your spouse, you may be able to create an advantage by using a health reimbursement arrangement, or an HRA is what we call those. And now these strategies work really good for a sole proprietorship or a C corporation. They're not really good for an S corporation unless you couple it with a sole prop management company. And that's a whole strategy for another day. But figuring out sole proprietorship or a C corp can use an HRA. A health reimbursement account, or HRA, health reimbursement arrangement, some people call it, or health reimbursement account, is an IRS-approved tax-advantage health benefit plan that's basically going to reimburse the employee, in this case, your family, for out-of-pocket medical expenses and your health insurance premiums. So it's a business deduction. It's 100% funded by the business or the employer, and the terms of the arrangement can provide the very first dollars for your medical coverage until your health insurance kicked in. So you may go in and put a high deductible health insurance plan in place and has a very low co-insurance amount. So the maximum out of pocket deductible may be $25,000. If you know you're going to have a lot of surgeries or whatever, if you know you're going to be dealing with this, an HRA may come into play. So you can ride the deductible way up, and therefore you're able to now deduct, if it's done right, all the medical expenses and the premiums at the company level, not at the Schedule A level. So it's an excellent little benefit here at HRA. There's a lot of rules. I'm going to go over some real fast ones here. This is not an exhaustive podcast or document on an HRA, but here's some basic little rules. First of all, you're probably going to need a health insurance plan to participate. You can't do it without a health insurance plan in most cases. The business owns the HRA. You do not. So whatever money you put into the HRA belongs to the business. It's actually on the balance sheets of the business. Only the business can put money into an HRA. You personally can't fund money into the HRA. It's a business asset. The HRA does not earn interest. So like an HSA, a health savings account, whenever you put money into an HSA, you can purchase stocks, bonds, mutual funds, real estate, businesses. I mean, there's a number of ways you can play with the HSA if it's properly utilized. The HRA does not earn any interest. It can reimburse anything that's on IRS publication 502. Now, 502 gives you the guidelines of what can be reimbursed, and the HRA can reimburse those things. The business determines the amount that is contributed to the HRA. The unused dollars on the HRA stays in the company. So they're not like an HSA. They don't belong to you. And finally, the money can be used to pay for your family medical expenses. So an HRA may be a reason, depending on your health conditions, to include your spouse on the business as an employee.
You're listening to the Financially Simple Podcast. Show your support by subscribing to this and our other educational business channels at financiallysimple.com.
Now we're going to get into some Social Security ideas, and I'm going to start by couching some knowledge for you. Many times I'll see individuals who place their spouse on the company so they can, quote, maximize Social Security. In fact, this last week, I ran into a couple that has just engaged our company Heritage Investors to help them prepare themselves for retirement. They're a business owner couple. They do quite well in revenue, almost over $10 million a year in revenue. Great little earnings. But in their S corporation, they pay each other $100,000. When I asked them, why are you paying yourself each $100,000? They said, well, we just figure that's the best way to get the most bang for our bucks for Social Security. And it's not. So let me give you some knowledge here. In that case, with both the couple, we're going to call them Fred and Tina again. In Fred and Tina's position, both of them are putting $100,000. Neither one of them are maxing out the Social Security allowable limit. So this year, she's right at $129,000. So I always say $130,000. If they were to receive a W-2 in the amount of $130,000, then they would be maxing out, or that individual would be maxing out the Social Security credits for the calculation purposes. So they're not. Neither one of them are maxing out. But get this. Let's say you have a non-working spouse who's never worked a day in your life, and one spouse has been pushing $130,000 for 10 years, and they're fully qualified. They're fully insured is what we'll call it. The non-working spouse is eligible for 50% of the working spouse's benefits. So let's say, for simplicity, that whenever we retire, the working spouse is going to get $3,000 a month in Social Security benefits. The non-working spouse who's never worked a day in their life is going to be eligible for 50%. So $1,500 a month in benefits. That's pretty amazing. Most people don't realize that. So one of the strategies we'll do, and we worked with this with one of our executive consultants, is we'll do a swapping strategy. Now, you got to be tactical. You got to know how to play the game is what I want to say. It's really not playing a game. It's just using planning. What we'll do is we'll fully maximize one business owner's pay for a period of 10 years to fully max it out. And then with the help of the consultants, and many times planners will get involved, and we'll run all sorts of Social Security calculations. But with the help of the team, we'll go in and we'll swap. We'll shift the income to the other partner or to the other employee, change duties within the company, totally change it all up, and now try to maximize two incomes over a period of time. That's a great way to do it. You may say, well, Justin, why don't you just do it over a 10-year period? Sometimes you can if there's enough money in the business cash flow. But this particular couple, they were paying themselves each $100,000. What we showed them is we could actually increase one and decrease the other. We increased one of their incomes up to $150,000 and decrease one of them down to $30,000, which is pretty much mirrored the way they were working within the company, the actual jobs. Then we actually created more Social Security benefits. So we're going to talk about that. That's called a Social Security arbitrage. In my particular case that I typed up here that I'm going to read to you, let's say Fred this time owns the company, and Fred is being paid $120,000 from his company, his S Corp in this case. And Tina is, she's rolling in it. She's making $150,000 as an employee somewhere else. What we could actually do is we could actually reduce Fred's salary down from $120,000 to $80,000. So a $40,000 reduction. And then we're going to give Tina that $40,000 reduction. There's actually saving $2,400 in Social Security taxes by doing that. You're like, dude, how? Okay, so in 2018, we had $28,400 was your maximum number. I say $130 for 2019. It's just the number I thought it's easy to understand. So let's say that once you hit over $130,000, like Tina would be doing in this case, she's already making $150 at her job. We're giving her another $40,000. She is earning more than $130,000. So because she's making more than $130,000 in income, the money over $130,000 is not taxed at the same level as those dollars beneath 130. There's a little bit of taxes on it, but for the most part, it's not. So we can take 6.2% of the $40,000, and that is a total of $2,480 in tax savings. That's a game. It's called Social Security arbitrage. We'll often use that and create some benefit for our clients on growing their Social Security payments for later in life. Another thing you can do with Social Security by adding your spouse is you can add Social Security credits. So I'm not going to get into the way the calculation works. That's a long story. But let's say that Tina has been working at a job for a couple of years and they had some babies and she didn't work for a while and she's really not insured. But we know if we pull this game off right, if we just give her $20,000 or $40,000 or $60,000 a year, we can push Tina into a position where now she is fully insured and she could potentially earn more than a non-working spouse. There's a calculation we can do for that. By adding your spouse to the payroll of the company, you may be able to get them fully insured or add Social Security credits to your spouse's calculation. So there's a lot of things you can do with Social Security planning, which comes into effect for our long-term retirement planning as well, just by adding your spouse to it. So it's not all about 401ks. It also can come into play with Social Security. Whew, that's a lot of information. We're going to wrap this thing up here in just a second. I'm going to give you a couple more things, and this is going to be fast fire here, okay? So one of the things you can potentially do by adding your spouse is legally deduct travel expenses with you and your spouse. Now, you have to be traveling for business reasons, and your spouse has to have a legitimate reason to travel with you. So you may say that they are your chauffeur. You may say that they are your scheduler. They are your assistant. Anything that you may have in your business. I have dentists whose spouses are hygienists. And so we end up having a legitimate reason for the spouse to travel with the business. Then you can create some deduction for you and your spouse on travel. Another thing you may be able to do is get group disability insurance. See, many times non-working spouses are not insured. But if you add them to the payroll and you roll them in the benefits, now you can get a little bit of disability insurance. Again, we hope that never happens. We don't want our spouses who are non-working to ever become disabled. But if you add them to the company and they legitimately work in the company, and it could be remedial jobs, we'll get to that in a second, then in effect, you may be able to get them group disability insurance. I saw this a couple of years ago, and it's always intrigued me. I talked to several CPAs. Some of them say they agree with this. Some of them say they don't. I want to say that I don't have an opinion, but it's something worth considering. Another thing you can do is you could potentially buy a third vehicle for your spouse as part of their job duties. Now, you have to have 3 vehicles. You need to have one for you. I'm assuming is a business expense. You're going to have a family commuter car, family business, or family car. You could potentially buy a third car that is a business expense and have a deductible business expense that way. Just an interesting fact. Now, if you're a C corporation, by adding your spouse to the company, you're going to reduce some of the taxes that are double taxed. So that's a benefit if you're a C corporation. How about this one? Number 10 here is if your spouse needs education, you can actually arrange to send your spouse back to school and have the education expenses that are incurred. As long as they're improving the employee job skills, then they'll be deductible for the company and tax-free to the employees. So think about that talk to your CPA again. I'm not giving you tax advice. That's not my job. I'm giving you some ideas that you can go and talk to your CPA. Some of these things may have changed in your particular state. Some of these things, I tried to do the best to make sure that some of these ideas were still legitimate. I think they all are, but talk to your CPA. So I'm just giving you 10 ideas that you can utilize. You say, Justin, my CPA doesn't talk this way. Reach out. We got a group of CPAs that we know and trust. They're very, very good. We were talking to one today. They were going through an audit, and the auditor actually gave them a clean bill of health, which is unheard of with CPAs. So I want to wrap this up by talking about your employee spouse. So here's some things you have to do if you're going to employ your spouse. Number 1, you got to give them a job description and an appropriate salary or appropriate income for that job description. You can't say that your spouse is your assistant and you're going to turn around and pay them $700,000. It doesn't work that way. So you have to have an appropriate title and appropriate salary. You need to have your spouse complete all the new hiring forms and treat them just like any other employee. They have to sign the same agreements. In our office, we have to have compliance manuals signed. My wife had to sign them as she's an employee of our company. She does our shopping for us. She does our event scheduling for us and our event coordination. She does a lot of the postage and clerical work for our team. Even though she doesn't come to the office much, she does a lot of that stuff. And so therefore she's paid. It has a job description and she had to fill out all the salaries. You have to make all the required deductions and withholdings. So if you're in a business that has a W-2, you treat your spouse as a W-2. So just consider that. You have to include your spouse in all the benefits programs. If you're eligible for a 401k, your spouse goes there. If you're eligible for health insurance, your spouse goes there. If you're eligible for disability, etc., your spouse goes there. Okay. And you should be able to prove that your spouse is actually doing the work. Come on, people. So many times I see, well, I pay my wife. Well, what does she do for you? Or I pay my husband. What does he do for you? Well, I don't know. Come on. You got to be able to prove that they're actually doing the work. All right. That's a no-brainer. And if your spouse is an officer in the business, so like my wife, she's part of our members of one of our businesses, then she actually has to keep the same duties as I do as the proprietor of the business. So that's how you treat your spouse as an employee. There's a lot of information I just gave you, and I'm sure that some of that you got glossed over, and I apologize. We're trying to keep the blog up to date, and this article with a full written format you can read and think about is coming out very soon. So we hope to have this typically within a week following the release of the show. So while you're on the blog, though, I want you to do me a favor. I want you to sign up for our newsletter. Our newsletter has been taken off. We're excited about it. We've had almost 10,000 individual listeners of the podcast. It is almost pushing a monthly basis. It's crazy how many people are listening that listen to the podcast. And we have a lot of people signing up for the newsletter. And the newsletter, I get emails back like, hey, Justin, this is really good. It's short, sweet, to the point. It gives you a couple of different things per week that you can look at and drive some thought to your business. If you don't have anybody that thinks like this in your life, reach out to us. Maybe we can help you. We have a point on the blog that says work with Justin. You can see what it's like to work with me, what it costs, what the details are. If you have questions, reach out to us. You know, I sign off every week by saying this. Life is hard. It is. It is hard. But man, life is good. We are blessed beyond measure, folks. We are. I have nothing to mully grub about. But I realize that life can be frustrating. I'm in the middle of tax season as we're recording this, and CPAs and tax attorneys and myself, we're going crazy dealing with the new tax changes from 2017. Money doesn't have to be frustrating. It really doesn't. We're going to continue to make our lives, at least financially, simple. Hey, y'all go out and create an awesome day.
You've been listening to the Financially Simple Podcast. For more business and personal financial help and information, head over to financiallysimple.com today.